For more on the impact of surging rates, let's bring in David Rosenberg, founder and president of Rosenberg Research. David, great to have you with us. And I wanted to ask you about, a part of the conversation we were just having, and that is what the HYG and the JNK is telling us. And I'm wondering if you see glass half full or glass half empty here, because the chart really says that maybe there's not too much going too badly. And I'm wondering, when you think about this lagged effect of rate hikes, when does that start hitting this part of the credit market? Because you would think that it would start hitting now.
Well, I think that when you're taking a look at the leading indicators, and we just got the money supply numbers today, and M2 is down a record 1.7% year over year. That's a leading indicator. I heard you guys talking about the yield curve. Another ironclad leading indicator, there's the Fed Loan Officer Survey, which has tightened dramatically in the last quarter across all types of bank credit. These are all leading indicators. It's a matter of timing. I think that right now you've got a situation where the stock markets and the credit markets seem to think that they have more time that they can buy before the boom really gets lowered on the economy. There's no doubt the economy is not strong, but it hasn't weakened precipitously. But the one thing we have to keep in mind is, whether it's money supply, the LEI, the yield curve, all these other things that we have in the crystal ball, it's telling me that the recession probably starts Q2 no later than Q3. And the time horizon for the markets, whether it's credit or equities, is shortened up so much that it's only when they see the whites of the eyes. And I think a lot of it will have to do as well with employment. Employment has to start contracting. Once employment starts contracting, and of course that's the bellwether coincident indicator, I think that's where you're going to find the risk on trade, really coming under downward pressure. Reality is that we're not there yet. But give it, I'd say, 3 or 4 months, and we're going to have a different economic picture on our hands.
So you think it's that long out? So I guess my question to you is, Dan talked about the bull case here, but all we've seen, and Jeff Mills speaks to this, really multiple expansion. Why are we seeing multiple expansion in an environment where people should be paying less for earnings, not more?
Well, I would totally agree with you on that, but we're talking here just very short-term divergences, and the stock market can operate, on its own dynamics, whether it's, fund flows or momentum chasing. I think you're 100% right. There is actually no better correlation with the multiple than real interest rates. And we've seen the real 10-year yield jump almost 50 basis points just over the past month. And it's got a very tight link with the PE multiple. In fact, when you map it out historically, the multiple actually should be much closer to 15, 16 than, say, 18. And then you got to slap on, if you have a recession view, which I do. I don't think we get out of this without a recession. It's just a matter of, what the timing is. I was talking about a recession throughout all of 2007. It didn't come until December that year, but it was still staring us in the face. And remember that the stock market saw it late. The stock market peaked just a couple of months ahead of the actual downturn. But I think that you're quite right. The multiple is inflated. I believe in Bob Farrell's rule number 1 on mean reversion. The multiple will mean revert, and it will do so against the backdrop of this very aggressive Fed, which has lifted both the term premium and at the same time the real rate. It's interesting that not much of this move in nominal bond yields has really been inflation expectations, despite the fact all of a sudden inflation is all the rage. It's really been the real rate, and that is not good news for the multiple. So I would just say give it time. We could be talking about something totally different, 4 weeks from now in terms of where that multiple is. Should be 15, 16, not 18. And then, we're talking about a recession, but, none of your viewers who are investors are buying GDP. They're buying earnings. And so where's Q4 earnings right now? Q4 earnings, the run rate is minus 4.7%. Last time I looked, Q1 is like negative 5.8. So the earnings recession has actually already started. And I think that would be the question is, what's the stock market not seeing when you're seeing declining earnings, not slowing earnings, and declining earnings estimates? So maybe it's still about liquidity or it's about technicals. Today was nothing more than bouncing sharply off the 200-day moving average. Today so sometimes, look, there's nothing fundamental about it. And maybe sometimes it's not just about valuations, it's about technicals. And I think today was more of a very powerful technical move with the 200-day moving average, holding in. What's going to happen a week from now? Does anybody really know? I think that'll be violated. But that was the story today.
David, great to speak with you. Thank you.
Thank you.
David Rosenberg, Rosenberg Research. David has a great Twitter feed. If you don't follow him, follow him. But he tweeted this chart out of S&P 500 earnings yield and the yield on the 6-month T-bill, and they're practically the same. So in this environment, what would you rather, right?
Well, if you're bullish, you'd rather take a shot on the market. But for me, it's the T-bill for some amount, Yeah. And one thing he said, though, just made me think when he said, reversion to the mean, doesn't go back to the mean. It goes beyond the mean.
Right, exactly.
And then
to
comes
get to
back.
the mean.
Yeah.
Sometimes people don't do the math on that, as they call it. Jeff, what do you make of Rosenberg's thoughts?
Well, I agree with him, and he mentioned earnings, and I think that that's sort of critically important here. And we keep talking about the lagged impact of interest rates on the economy. One of the things with the highest correlation that we track is earnings and ISM manufacturing PMI. If you look at the lagged impact of earnings on manufacturing PMI, it's actually about 12 to 18 months, and that correlation is very tight going back decades and decades. So our point of view is that really that view or that move in earnings, that move in rates is only just starting to hit manufacturing PMI. That's going to continue lower. That's going to drag earnings lower. I think that's the key to all this right now.
Yeah, I'd say the one thing we haven't talked about is sentiment right here. And, again, at the October lows, I think sentiment was universally bad among strategists and among investors, among pundits, that sort of thing. And, right now, it's kind of interesting. We had that huge rally, 18% off the lows. When I listen to David, and I've been listening to David for 20 years, and I just think he is one of the masters at picking apart what is often on Wall Street a universal bullish sort of stance. But right now, it's the exact opposite. Like, all the other strategists have come into his zone right now. And that does make me a little nervous. It's really hard to find a bullish strategist right now.
Isn't it still interesting? I mean, a lot of strategists have come in, but if you really read them carefully, they've reduced their S&P outlook to 4,000, 40, 50, or whatever. But the PE that they're still looking at is like 18 because they haven't lowered their earnings estimates a lot. So they really are fairly bullish, even within this wrapper of being more bearish, moving towards that bearish consensus.
Whether they realize it or not, right? And it's, again, why are you paying a historic market multiple in an environment where we haven't seen this literally in decades, right? Number one. And the other side of the equation is, as David mentioned, the earnings part is coming down as well. So it all becomes math. And listen, I'm not suggesting we're getting down to a 14 or 15, but even a 16 multiple on $210, $220 of earnings is still significantly lower than we are now.